This is the first of a series of readings on using multiples in equity valuation. In this video, we're dealing only with the first of those learning outcome statements, that being part A, which is to get the foundations right and to understand exactly what it is that you're going to be doing in this part of your studies of equity valuation. You are required to be able to explain the use of multiples in equity valuation, including the difference between the method of comparables and the method of fundamentals and relative and intrinsic valuation. The valuation multiple is something that I am sure you have encountered before. It is some kind of ratio like the price earnings or PE ratio. Less frequently, but definitely in widespread use, you see other measures such as the price to book, the PB ratio, also known as market to book, and the EV to EBITDA, the enterprise value to EBITDA valuation multiple, the benchmark. Although this is not mentioned in the learning outcome statement, it is absolutely fundamental to your understanding of how to value equity using the method of multiples, that you understand that you need some kind of benchmark. And there are two different ways of calculating what that benchmark valuation multiple will be. Either you use a comparable multiple, which is in very broad summary, the average of a peer group, a comparable group of companies, or a fundamental multiple. And that is a rather interesting construct that derives from the Gordon growth model and a little bit of algebra that can show that it is possible to determine what a multiple such as the price earnings ratio should be simply using the inputs into the Gordon growth model, which are also known as the equities fundamentals, and they are its cash flows, its growth, and its risk and return characteristics. You also have to know the difference between relative and intrinsic valuation. The relative valuation is the method in which you take the benchmark that you have calculated and you compare it with the target's actual multiple. That, I suspect, may not have much meaning for you at this stage, but I assure you by the end of this video, you will have a much clearer understanding of what that is all about. Intrinsic value. Now, this one is much more closely related to your previous studies of, for example, the Gordon growth model and free cash flow models. In those cash flow based models, you are exclusively busy with the determination of an intrinsic value for a company. And you are, I believe, already familiar with what to do with that intrinsic value. In summary, on this slide, we mentioned that you compare this with market price, but that is exactly the same as the action you would take in analyzing an equity instrument using the cash flow based methodology. On the right hand side is a quick reference table that I think will be useful in the future as a quick reference guide, but it is not necessarily the best way to get your head around what is going on with using a multiple to get a relative valuation or an intrinsic valuation. Let's look at the next slide. This is the process that applies throughout the valuation of equity using the method of multiples. Recall that there are two main approaches in this methodology. You could apply a relative valuation or an intrinsic valuation. The first two steps on this slide apply to both of those approaches. Whether you are doing relative or intrinsic, it doesn't matter. You need a benchmark. And you also need to do something called normalization of the denominator, which means that adjustments are likely to be required to the earnings number in a price earnings ratio, the book value of equity number in a PB valuation, or the EBITDA number in an EV EBITDA valuation. So those first two steps are common to the valuation technique, regardless of whether you are doing an intrinsic or a relative valuation. Then at step 3, things branch out. If you are doing a relative valuation, you apply step 3A, which is to calculate the actual multiple as per that formula, and as we will look at in more detail in further videos in the series, and compare it to the benchmark. If instead you are doing an intrinsic valuation, then you would use the benchmark to determine that intrinsic value and then compare that to the market price. Once again, I believe that it may well be the case that this discussion holds not very much meaning for you. Therefore, we will look at an example on the next slide. On the left-hand side, we have the relative valuation visualization of 3 different outcomes from a valuation process. The actual multiple could be placed as in that diagram above the benchmark in case A, at or around the benchmark in case B, or below the benchmark in case C. And on the right-hand side, with the intrinsic valuation, the line of comparison is no longer the benchmark, it is the market price. And once again, we have 3 different valuation outcomes: A, above the market price line; B, about at the market price line; and C, below it. Back to relative valuation. In case A, the actual multiple is higher than the benchmark. And the way I think it is best to understand this situation is to think about the benchmark in a relative valuation as the justified value. And if the actual multiple that you calculate is higher than the benchmark, which is a justified level, that indicates that under the relative valuation approach, in case A, that share looks as though it is overvalued, and the analyst's recommendation, the investor's decision, would be to sell that share. In case C, the actual multiple is below the level at which it is justified, and therefore in case C, the share is undervalued, and the investor action would be to buy that share. Turning attention to intrinsic valuation, the situation is flipped from relative valuation. Intrinsic value A is above the market price. I think that point is important enough to repeat, and just to stop and pause and take a look at the left-hand side and the right-hand side. With relative valuation on the left-hand side, the benchmark is in plain sight, and the benchmark represents the justified value for your share. On the right-hand side, the benchmark has oddly disappeared, but the intrinsic value calculation embeds the benchmark. So on the right-hand side with intrinsic value, the benchmark is embedded in, included in the intrinsic value, and therefore we have a swapped around point of comparison. Let's stay with intrinsic valuation. So the justifiable value, the intrinsic value in case A, is above the market price. Therefore, the market has undervalued that share in case A, and the investor would buy. In case C, this time the market price is too high in terms of what the benchmark, intrinsic, or justified value of share C is. Therefore, share C is overvalued by the market, and therefore the appropriate rational investor action would be to sell. In case B, I've tried to represent the fact that there is a blurriness, a margin of error around the market price, and therefore one tends to think not in terms of an exact match, but an approximately equal to operator as you make those evaluations.